Alrighty, just gonna make sure that it works. Everything should be working. So this week we have a bit of a more nuanced topic to discuss. More recently, there's been a lot of talk about gold, about central bank buying, and it's actually been on the headlines for months now. But I thought it would be an interesting opportunity to talk about this because I keep seeing a lot of people talk about gold online, central bank, and I figured it's going to be an interesting idea to look at the U.S. dollar, look at the U.S. economy, which is what the U.S. dollar is, what gold and a lot of other commodities are priced in. So I figured we can talk more about that. But the housekeeping, you might notice that if the sound sounds a bit off, if there's been a bit of technical difficulties with the microphone, that'll be fixed hopefully next week. So bear with me this week. But if it sounds a little bit different, if there's any issues, feel free to drop a comment below or drop something in the chat. So yeah, let's dive right in. So thought it'd be interesting. I'll start this. Let's look at the price of gold, and I'm singling this out now. I'll say it now. Hold on a minute. Let me just pull up. Pulled up some tabs, but I thought it'd be interesting. Let's just type in gold. Oh, actually, I have it up open here. So I think we can go back to 2020, and I want to zoom out on gold because commodities in general, I'll preface this, commodities, especially metals, are cyclical. And what's interesting about gold is gold as a precious metal, it also plays a role as a safe haven asset. For those of you who watch or follow along with my Commodity Bro podcast, I did an episode where I talk about the role of gold in central banking, how there was the 1971 Nixon era removed from the gold standard, and that was more just because of debt management in the U.S. I'll leave it at that. I know that under the Nixon era, actually before that, that the U.S. took on a lot of debt post the Second World War with the collapse of collapse of the British pound, but the Brits essentially after the war, they were so in debt that they had essentially in the Bretton Woods agreement, I believe it was the Bretton Woods Agreement, they had agreed, correct me if I'm wrong, they had agreed to basically put the U.S. move to a U.S. currency or U.S. dollar backed commodities market. So meaning a majority of commodities around the world are going to be that are exchange listed would be priced in USD. And what that does is it creates a liability for some countries, especially countries with volatile currency that might also be worse than but might not necessarily. I go back to 70s. Sorry, it's two things at once. It puts a bit of a strain on countries that have a volatile currency, like I said, but also they're not necessarily able to. They essentially have to hold U.S. dollars. So, for example, on reserve. So, for example, I guess actually, before I go into that, I should say that I should clarify the reason they have to hold U.S. dollars on reserve, for those of you who might, just to kind of walk you through the process, is typically speaking, if they want to execute a trade, if they want to purchase, for example, if they're trying to buy a commodity that's priced in U.S. dollars, they need to maintain some sort of liquidity in case they needed to buy, in the case they were wanting to buy, in the case they needed to buy more gold in the future. So it's kind of like a trade-off. There's a lot of analysis and quantitative analysis that goes into a lot of these big trading firms that they have analysts sitting there and they'll try and figure out if we can forecast demand, we can forecast supply, and there's a lot of other supply chain factors and geopolitical factors that play into that. But forecasting demand and supply, and also I should add policy, it's a whole other thing, more nuanced there, but they have to, if you can forecast demand and supply, you can essentially foresee and you can actually predict, and if you're able to kind of predict where, or have an idea of which direction you think the price might move in a commodity, you can kind of see how much, if there's an undersupply or if you think there's going to be an undersupply in the future, so you might want to take a position where a future is a position where you're going to get like a lock in a price. Like you want to buy. You'll essentially lock in a position now or buy more gold now for the future, or whatever the commodity you're hedging. I mean, without going into the basics of hedging, but that's essentially why you want to hold reserves. And a lot of these, and I think a lot of people tend to make are a bit dramatic about the price of gold. I mean, if you think about the fact that, I mean, you look at the gold, we haven't seen it rise this high, and I'll get to that why I think we've seen a lot of this price bump. We saw this in the 80s after, this is post Nixon era, but you saw after Nixon had removed from the gold standard in 1971, you saw kind of this slow rise. And now if we I want to kind of zoom into like the past 10 years, for example. In the past 10 years, or I should say even like in the past 3 years, first of all, yeah, we are priced in USD. Good. In the past 10 years or so, or 3 years, yeah, I'd say I'm looking at 3 years. So I'll just look at here, like those of you who remember 2020. So I remember after COVID, we saw almost like it was a massive recession. You know, a lot of companies, a lot of production and shipping supply chains had to shut down. And what that did is it created essentially a global bottleneck. Whereas we keep talking, I mean, in the last week's live stream, we spoke about oil and the bottlenecks in the Strait of Hormuz, Strait of Malacca, and we talked about oil, but we also forget too that when I say global bottleneck, I mean, imagine that happening on a global stage. And the reason that happened at a global stage is, again, because everyone's shutting down, and so you're left with internal production, or internal whatever you have in the country after all the other ports are shut down is what you're stuck with until the ports open up again. So it creates a bottleneck. And what this has essentially done is gold has essentially I'm trying to phrase it correctly. If I think there's been a lot. I think we saw a lot, or I know that we've seen a lot more of we saw a bit of a spike in gold. I should go back. We better 2020. Let's go back to 2019 just to show you. So remember in 2020, you saw a bit of a spike, and I remember everyone thought this is crazy. Gold's gone up, and what's interesting about this is we saw it kind of level up, we saw it flat out, and it didn't really start climbing again until 2024. And I want to emphasize 2020, the pandemic era, it was although there's a lot of similarities, what we're seeing now is something very different. And I'll explain why I mentioned earlier in a moment why I think a lot of people are being a bit of drama queens about this. I think there's a lot more nuance, and I think what's going to happen is something similar to the end of the 2020 bull, which is where it's going to level out for the time being. And you've already started to see that if you look. But I think we saw a lot of that. Gold has a safe haven asset. It's a hedge against inflation, meaning inflation. So meaning if the central banks foresee an economic downturn, and there's a lot of indicators. You can look at interest rates, you can look at inflation, you can look at GDP spending, GDP growth. If GDP grows too quickly, that's a red flag for possible recessionary, because typically speaking, when we see high, and I can actually look at that in a moment, actually that might be interesting, but typically speaking, when we look at GDP spending, I'll go to that in a moment. When we look at GDP spending or inflation or interest rates, and then central banks say, okay, we think there's going to be a recession. You know, the Bank of Canada or the Fed has rose interest rates. Government's starting to rein back or pull back a bit. The government spending started to pull back a bit. We've seen unemployment rise. A lot of these are positive. I guess they're negative indications, but they're positive indications that the price of gold is going to go up. You know, it's like I heard this quote I'm just paraphrasing this, but I heard at a keynote at a PDAC, Prospect Search and Developers conference last year. They're saying, it's kind of sinister, but when the precious metals are doing, when you're investing in precious, you're kind of preying on the economic downturn in the sense that when it's negative, when it's poor economic times, your investment in gold is going to do really, really well. And when it's positive, your gold might not go down, but it might not go up either. Because again, a lot of hard commodities. Their pricing is heavily affected by the supply and demand. And if there's low demand because inflation's not very high and people aren't looking for a store of wealth for their money in a high inflationary period, they are not likely to buy more gold. So, and this is what we're seeing with central banks. And I think when a lot of people say that, oh, we're seeing a bit of a recovery, but we're going back into a recession, or oh, we see more of the gold, or we're seeing a return away from the U.S. dollar. I think what's more likely, and I should show that. I'll go to the GDP, back to the GDP thing, because I think that's interesting. But where is it? Here was the chart. What I think is interesting is here. Let's go to 1 year. This is really where you begin to see this relate. Oh, yeah, let's actually zone out to 2 years. So we've seen a bit of a dance kind of thing where the U.S. dollar has seen, I mean, over the past, what is this, 2 years? Over the past 2 years, the U.S. dollar index, or the U.S. dollar, I use the U.S. dollar index, but the U.S. dollar has essentially undergone a lot of volatility. This is a combination of again a lot of people. Again, this is a factor of people holding U.S. dollar or other things. That's a whole other discussion. But what's interesting is you've seen almost like with the volatility, you've seen almost the past 2 years almost like a rise in a steady rise in almost like a vertical line in like a rise, like a horizontal, or like in or not vertical, I say a diagonal line increase, almost like in gold, but then dollar has gone up and down. And so when people start saying that, and why I think a lot of it's more or a bit of a drama, or people are overreacting. I think when they talk about, I believe people are overreacting. My thought process is because if historically the U.S. dollar is the dollar that people are here. Let's zone out. Sorry, I was trying to zone out. If you see here, historically, people are using the U.S. dollar as the currency that they're doing they're carrying out international trades in with, or that's the go-to currency, global currency. Then of course you're going to have a very liquid market, and liquid markets are very volatile. So it's about even if you just look at the price of gold, there's been periods of volatility, but there's also been a rapid, very good increases. And what I should note is towards the end of 2022, early 2023, we saw a bit of an economic upturn and a bit of an upturn here, which has meant that gold is on a dip. But then again, as poor economic times mounted on again, and again, we saw a lot of rapid inflation. This is what happened. This is essentially what happened again with the price of gold, and why I think, there's an expression in mathematics. You can have a mathematical correlation, but not that there isn't a correlation. I think there is a correlation, but I think people are focusing too much on the mathematical correlation, the quantitative side, but they're not focusing on the nuanced variables that are play here. And I think that the U.S. dollar is affected by is not specifically, like, it's not the only go-to. And what I mean by that is, the U.S. dollar, again, like I said, is very volatile. But then again, and so is the price of gold. But if it's a liquid market, I think the liquidity aspect of the market tells more about the U.S. dollar than the price of gold. So, I mean, I without dwelling on that, I kind of want to go, where is? Well, I'll go to here. I'll go to here. Here was the other article that I found. For those of you interested, central bank. This is an article by the World Gold Council, but thought it'd be interesting to show kind of like the central bank, and we've seen kind of a net positive in positions on the gold here. Set all. Seen a bit of a net positive, or we have seen a net positive, substantial net positive. And what's interesting, again, like I said, if there's a net positive in gold, and there's a lot more at stake, and it's like we can use the same, and I guess it's related, but it's unrelated. I can give a bit of an analogy for this. for example, I turned on my phone the other day and I saw an article in the block for something like 7 or 8 days ago that they had that there was a massive whale who sold Bitcoin, a whale investor, like a large investor that sold millions and millions of dollars of Bitcoin to buy Ethereum, and essentially that's a market moving portfolio. I mean, Bitcoin has dropped. I don't know the exact. I can show that. Bitcoin price. It's kind of dropped over the past year. This is past day. Let's look at 1 month. You see, it dropped significantly towards the end of the month, and because there's been a whale investor that's basically just sold for a few days. He just sold millions of dollars at a time. And where am I going with this? With the gold is central banks have a lot of buying power. I mean, way more. And what I think people forget too is when by the time the retail investors and the corporate investors are getting into gold, it's too late. I believe in this concept of, there's always this concept that I have of, and I have of, I've always thought about, which was, there's like, what do you call it? What's the word I'm looking for? Not premature. Preemptive, I guess, is for lack of better words, preemptive, or I'm blanking on the word, but preemptive buying. And so strategic accumulation. Strategic accumulation. So the central banks, because as the central banks as the monetary policy makers, so they're forecasting inflation, they're forecasting interest rates, and they come to a decision that the central bank comes to a decision that they're going to that they're going to raise interest rates because inflation is too high, GDP is growing too fast. So what they're now going to do is they're going to raise interest rates. But what does this mean? This means that borrowing is more expensive. The dollar is going, I guess the dollar is not going as far because inflation is high, and again, borrowing power and purchasing power is eroding. There's less demand for borrowing because of the interest rates, and this is essentially this is like why, all these variables culminate in, again, the economic growth slowing. So again, it slows down inflation. And what's interesting is typically speaking, when that happens, so these central banks will then go and purchase gold because they're looking, because again, the central bank also wants to protect its reserves. So again, it would purchase gold, and that's, I think, what we're seeing is a lot of these are big whale investments by central banks, and I could say whale, but these are massive investments, and this is why you're seeing a lot of these net positive positions. And you just look at the sheer scale of it. These are different central banks, and just look at the sheer scale. Like Poland, Azerbaijan, China, Turkey, Kazakhstan, Qatar. And these are significant. These are significant. But just look at the Poland. The fact that this is in net purchases. So what I think is interesting is, I think what's interesting about this is, where was the chart? Where was the other chart? No, that wasn't it. Anyways, what I think is, here, let's go back to this chart. What I think is, where was I going with this? What I think is interesting here to think about is, I guess, without going on a long tangent, if the price of gold is I think we're more likely to see, looking forward, I think we're more likely to see, I don't think the volatility, because we are still seeing like record high unemployment rate in Canada. I'll talk to Canada for a moment because I know the US is in a different position. Not being an American, I won't speak to that, but the Canadian economy is under a weird situation. We have high unemployment, we have relatively high inflation, but it's scaled back a bit. But then again, that's creeping up, and we also hear more and more about the possibility we have stable interest rates. Like let's pull up the Canadian interest rates. Treasury bill yield on your Canadian interest rate. So here, when I yeah, no, I don't want that. There we go. So we've seen stable rates, and to give a bit of context, you usually see about a quarter to a half basis point fluctuation. Very rare half a basis point is usually quarter basis point, but 0.25% for those of you unfamiliar with basis point. Well, but this is a good sign and it's a bad sign. I think we're more. If it's, I think it's stable. We've seen a bit of. But I think a lot of it's the cart before the horse. Because we're putting the cart before the horse in Canada. Because, for example, I don't believe. Correct me if I'm wrong. I don't believe the Carney administration has yet put out their this year's. They're expected to put out their budget, but. And we're also talking too about there's going to be a lot of, I hear there's rumors how there's going to be a lot of cuts in the government. There's going to be a lot of cuts and we're going to see a bit of a recession coming in. And how long this recession, there's speculation. It could be a few quarters. It could be a couple of years, from what I've heard. But what's interesting, what's not interesting, what this is kind of, what I'm getting at here is just this like this whole thing of gold's going to go, everyone's worried because everyone's happy because gold's going to go gold's going up and it's going to, I guess it's going to keep going up and up and up. But I think if we're but I think I believe it's more likely that if gold were to if we were to get the budget tomorrow, if we were to get the budget from Carney, if we were to get, or from the government of Canada, and we were to see that the inflation's forecast, if things were to start getting, I guess, worse economically, and gold likely to go up, but I mean, back to the U.S. and then even back to the U.S. dollar, you have the. If the tariffs have been there's been talk about tariffs influencing the U.S. dollar, and if tariffs are, I don't know, so to speak, if the U.S. dollar drops because demand for the U.S. dollar and demand for the U.S. dollar is weakening, and because people are selling their T-bills. I think this is more a short-term reaction to tariffs. I think people need to remember we live in a democratic country. America is a democratic country. Every 4 years, we're gonna see you set every 4 to 8 years. I mean, Trump only has this is Trump's last term. He can't run again. So even if the Republicans win the next election in the U.S., there's gonna be another president. Who that could be? Maybe JD Vance, maybe someone else, but irrelevant for this conversation. But the policy can change. So I think it's more of a. I think it's more of a putting the cart before the horse when people say, oh, the U.S. dollar is it's not gonna be the reserve currency. I think there's a lot more that has to happen before the U.S. dollar is basically trashed by the other countries. And I mean, if you look at it from the perspective, from the old saying, there's a lot of, you don't just go from like wealthy to homeless. There's a lot of steps that happen in between. So I think it's the same thing with the U.S. dollar. There's a lot of steps. There's a lot of things that have to happen, and it's a factor of I guess it's a factor of, if tomorrow all of the global trade, if every commodity that was priced in U.S. dollar would automatically switch, which wouldn't happen overnight, then it's more likely to see a transition. But if they were all suddenly switch off the U.S. dollar, if everyone just sold the U.S. dollar, U.S. dollar, or their U.S. dollar holdings and their treasury and everything would have then the U.S. dollar would collapse. But there's still always going to be a demand for the U.S. dollar, and even if it diminishes, it'll happen over a long time. I mean, the British pound didn't disappear right after the Second World War. It was a transitionary period till leading up to Bretton Woods. So yeah, so that's why I think it's going. That's why I believe it's going with this whole talk of oh no, there's this this whole doomsday talk. Dollars dropping and dollar index is dropping and gold is soaring. And I think as gold slows, as growth in the price of gold slows, and we see more of a level out, like we are seeing a bit toward here, we're going to see less volatility. I think as a combination of that will contribute and contribute to less volatility, because also don't forget the U.S. economy is recovering faster than Canada, and being priced in U.S. dollar, the US. That's why, I mean, that's the big correlation with the US dollar. It's priced in the US dollar. So of course there's going to be that's a factor of influence, but there's a lot. It's a lot more nuanced. I know. I hope this was informative. If you have any questions or comments, concerns, or any just you curious about anything and we discussed on this channel, drop a comment below. Subscribe to the channel. The YouTube algorithm's a bit finicky, so if you could subscribe, and like this video, subscribe, and turn your notifications on so you never miss an episode. Every Monday at noon. We have 12 noon Eastern time. We have the Commodity Bro podcast. It's where I break down geopolitics, supply chain dynamics, energy policy, a whole lot of interesting stuff. And don't forget, stay tuned to the channel. Eventually, I'm planning on releasing other videos outside of this live stream series and the podcast. So stay tuned. Don't forget to subscribe and turn your notifications on.